I'm Akshara Menon from pmsbazaar, and I'm delighted to welcome you. Today's session is particularly exciting as we deep dive into the growing private credit market, a space that has gained immense traction globally. With the traditional banks tightening the lending norms and business seeking flexible capital solutions, private credit has emerged as a powerful alternative, offering investors a blend of stability, predictable returns, and attractive risk-adjusted yields. In this session, we will explore rated performing credits and why they have become a preferred choice for both institutional and individual investors. Through the session, you will gain insights into what makes these funds attractive, their structure, risk return profile, and investment strategy. The key drivers behind their rising demand, such as stability, predictable returns, and risk mitigation compared to the traditional debt instruments, and how these funds fit into the broader investment portfolio, offering compelling alternative to a conventional fixed income and equity investments. Now let's introduce the distinguished speakers. First speaker of the day, Mr. Karthik Athreya. Karthik oversees the alternative credit strategy at Sundaram Alternates and brings 25 years of experience across principal investing, funds management, investment banking, and corporate finance. Previously, he led the India business of Clearwater Capital. He has also worked with Rabo, Arthur Andersen, and PwC. Karthik is a chartered accountant and alumnus of Loyola College. Welcome to the show, sir. Moving on to the next speaker, Mr. Vatsal Tandon. Vatsal has 12 years of experience across investment banking, investment management, corporate banking, and credit analysis. He has worked with JM Financial and Accra FinCap Limited, while he played a key role in sourcing and structuring transactions, delivering returns over approximately 13 to 16% for the stakeholders. At Accra FinCap, he was instrumental in growing corporate lending books to approximately around $200 million within 5 years, maintaining a zero default portfolio and generating an IRR of approximately 14%. Welcome to the show, sir. A common face in the Alternative Universe series, Mr. Arjun Nagarajan. Arjun is a chief economist and communications manager at Sundaram Mutual. With over 12 years in equity markets and prior experience in academia, Arjun has actively contributed to policy discussions at NITI Aayog and even participated in pre-budget roundtable with Honorable Prime Minister of India in 2020 and 2021. With that, now I hand over the session to Mr. Arjun to take it forward. Before that, I would request the audience to put up their questions on the Q&A box, which will be taken at the end of the session. Over to you, sir.
Thanks a lot. Thanks a lot, Akshara. Pleasure to be here and pleasure to have Karthik and Vatsal today on the show. So this is the Alternates Universe Season 2, Episode 7. So what we will be talking about today is why rated performing credit funds are popular with institutional individual investors. Now, in this entire conversation, we'll be touching upon Sundaram's Performing Credit Opportunities Fund, and we'll be referring to this as a PCOF. So whenever you hear PCOF, it is Performing Credit Opportunities Fund. Now, this conversation will largely be about the credit space and in particular, private credit. Now, before we start, I find it very important to state some numbers here on Sundaram Alternates track record that sitting out of Sundaram Asset Management business, I was not quite aware of. Now, Sundaram Alternates Private Credit has a track record of around 7 years. It has raised around 3,100 crores across 5 Cat 2 AIFs. Now, 3,500 crores have been invested across 65 deals with zero capital loss. You heard it right, zero capital loss, and is currently closing 17% gross investor returns. Now, like I said, I come from the equities business, so I've been very curious to understand the alternate side, and I found them very, very interesting. So here are some broad numbers for you investors. The market for alternate credit is roughly around $80 billion in an economy that's growing at 6% plus in real terms. In nominal terms, this is just above 11%, and therefore the private non-bank credit market is estimated anywhere between 10 to $23 billion, and it is growing at a CAGR of 10 to 15%. Apart from the usual areas of private infrastructure, manufacturing, education, health, and other services sectors, there seems to be a massive amount of credit demand that is felt on the ground that is not being met by bank and capital markets. So from Sundaram, PCOF is the latest in Sundaram's product portfolio that's being launched. Now, thanks a lot to Karthik and Vatsal for taking the time out. It's wonderful to have both of them on the show today on the Alternates Universe. Hi, Karthik, and welcome to the show.
Thank you, Arjun.
Yeah, I'm quite a novice here when it comes to all of this. So today I'll really have to pick your brains and you'll have to bear with me while I ask you some very simple questions so I get to understand the space better. And so our viewers also get their questions answered well ahead of their Q&A.
Sure.
Yeah, so even before you get the chance to speak about Sundaram Alternates, I started off today with a brief introduction. And what stood out for me was the zero capital loss bit. Now, this seemed important to me. So you can touch upon why and if you think this really needs to be stressed. Can you please share with us Sundaram Alternates' experience in private credit leading up to this very launch of Peacock? So two questions there. One, the zero capital loss, does the stress really need to be there? And second, your experience with Sundaram Alternates private credit. Please do.
Sure. Thank you to pmsbazaar and Arjun. Very, as usual, on-point questions. Let me step back a little bit and give the audience a sense. Although private credit is very, very widely, has been debated, discussed, pitched by several fund managers to investors and so on over the last 5 odd years. I think at a macro level, the way we look at the business is there are 3 or 4 spaces within private credit, which is an overall overarching term. One is returns perhaps between, let's say, 10, 11% and 13, 14%, which typically are deemed as reasonably, good credit, where there is high visibility of cash flows and so on and so forth. Most of the money in the private credit AIF universe has been raised in this bucket. There are several funds, operating here, like ICICI, Pru, Investec, Axis, the Sundaram Peacock Fund, which we will get a chance to talk a little bit about today, and many, many others. And then there is a 14 plus to, let's say, 16, 17%, which are high yield strategies, and they may straddle different investment niches like real estate, which Sundaram is now recently closed its fund number 4, and then you also have corporate credit, which deal with situations like acquisition financing, restructurings, some level of asset buyouts, cash flow mismatch resolutions, and so on, which by its very definition make it difficult for banks and NBFCs to lend to. And as a result of which, private credit funds have stepped in there to tap that yield. And most of the strategy of Sundaram Alternates to date has been in that bucket of roughly 15 plus to 17 odd percent, which is what you refer to in your introduction. And then there is a series of strategies which deal with high risk, high return, where investors can hope to make between, let's say, 17 plus to close to 19, 20%. And all of these returns I'm talking about are investor level returns. The fund may, make, whatever more that it can, but effectively it's gross returns in the hands of investors. And then, there is a waterfall of fees and so on. So net returns will be roughly 1.5 to 2% lower than the numbers that I'm stating right now. But just from a gross investor return perspective, 11 to 14% bucket, 14 to 17% bucket, 17 to 20% bucket, which are things like distressed, stressed, equity-like situations, early stage, greenfield investments, and so on, which effectively assume an equity risk, but they could have underlying protection in terms of some sort of security, the structure of the instrument itself being credit, and so on and so forth. So broadly 3 spaces, and then outside of this, on the upside, beyond 20%, you could have strategies which again are variants of pure equity type returns, which could usually are dominated by offshore funds like Apollo, PAG, Oaktree, and so on. And at the lower end of the spectrum, you will have listed debt, which comprises the whole range of bonds between AAA and, let's say, BBB plus, which usually tend to generate gross returns of between 7.5 and, let's say, 12%. So this is sort of at the lower end, which is perceived as the safer end of the credit spectrum, and then at 17 to 20 is the higher end of risk as far as the credit spectrum is concerned. So this is the overall split, from a private credit universe. So within this performing credit, we have our own definition at Sundaram, which effectively is reflected in the track record that you mentioned, where we've done over 60 transactions, deployed close to 4,000 crores, not lost capital, touch wood. And the reason for this is because it's interesting for the audience to know that there are two sort of guiding factors in terms of how Sundaram Alternates, which is the investment arm from an AIF and a credit standpoint, as far as Sundaram Group is concerned, is sort of in many ways used to. One is that the private credit funds itself are sponsored directly by Sundaram Finance, which, as many in this audience would know, is a AAA rated entity, a flagship company of the Sundaram Group, been around for 7 decades, known for safety, solid foundations, and so on. So a lot of the culture, which is a credit culture, a risk management framework, risk thinking, downside protection, all of that automatically gets transported from Sundaram Finance onto the private credit funds investment policy, credit policy strategy. And this has a significant bearing in terms of the capital protection that each of the investments that out of our funds are made. The second is that we are operationally owned by an AMC, which is Sundaram Asset Management Company that manages the debt and the equity mutual funds where you are sitting, Arjun. Which has a asset management culture separately, where we need to be nimble. We need to look at customer as investor as our only customer. We need to generate risk-adjusted returns. We need to be competitive in the market. So all of those asset management traits come to us from Sundaram Asset Management Company, and all the risk thinking comes from Sundaram Finance directly. So it's a very unique, I would say, situation where our private credit strategies are all based on a dual, I would say, opposing sandwich of risk and of need to stay nimble, agile, and so on.
Best of both worlds.
Yeah, it is, well, depending on how you look at it, if you're an investment team, then it becomes a pretty challenging proposition. But we've thrived in this environment. And because of this, I would largely attribute our investment policies and credit strategies to have not lost money, where we will only do things that are senior secured, where we will have tangible assets, highly visible cash flows, all the credit enhancements that you can think of in terms of guarantees, personal and corporate share pledges, strict financial covenants that monitor each of our investments, and so on. So there is a great amount of discipline and consistency that is expected to be followed by all the private credit funds, which is really the hallmark of where Sundaram Finance comes from as far as credit evaluation and credit execution goes. So I would attribute the culture of our holding and how we execute to largely how we performed as a private credit strategy. So this is sort of one part. But coming to your second question, in this whole universe of private credit, what is performing credit? I mean, everybody talks about performing credit very simply. And that to us at Sundaram Alternates means a few things. One is that we need to be focused on capital protection, and capital protection means that your tangible security backed as far as every investment goes, anywhere in the range of 1.5 to 2 times cover, and these are covers coming from assets that can have monetizable value, or you are able to monetize them, because going into courts and fighting long drawn legal battles can be a challenging prospect. So effectively, the asset has to be of a certain nature and position where you're able to extract value from it reasonably quickly. In addition, from a capital protection point of view, you want to back businesses, particularly in corporate credit, as far as our corporate credit strategies are concerned, which PCOF is a part of. You need to back businesses that have been in existence for a while, where there is high visibility of cash flow, there is stickiness of customers. The enterprise itself is not heavily leveraged in terms of debt. There is enough equity headroom. And for example, in the first corporate credit fund that Sundaram Alternates launched in 2022, which is a little over 1,000 crores, and we've deployed over 70% of that. That portfolio is currently running at close to 18%. We would have a debt EBITDA, for example, on the underlying of not more than 1:4. Whereas we see competitive transactions in the market happen at 6 times debt to EBITDA, 7 times debt to EBITDA, which in our opinion is a pretty tricky prospect when it comes to the ability of that underlying business to battle events, God forbid, should they occur. And so the capital protection part for us is to have our own security structure, to have escrow and lien on cash. In addition, we will have credit enhancements which create great incentives and alignment of interest with promoters to pay us, which would be personal guarantees, corporate guarantees from a flagship entity, which is very valuable, where there is significant equity value. In addition, we will have post-dated checks. We will have NOCs and financial covenants that monitor on a quarter-on-quarter basis how the business should perform versus promises made to the fund. And so it's a very, very active management and monitoring strategy based on which one is consistently able to stay on top of the credit. So that's also in a way buffered by a requirement out of 100% of the deals that we do to have quarterly interest payments. So we distribute income on a quarterly basis to all our investors, whether it is fees, whether it is interest, whether it is any form of redemption premiums, in any which way we get income is 100% distributed as a current yield to our investors. And this serves two purposes for our investors. One is that we consistently receive income, so they know that the underlying investments of the fund are working. The second is it's a consistent risk reduction. So anybody who commits 1 crore of capital, from the first quarter in which they commit that capital and invest it, they will start getting returns back. That returns could be 10%, 12%, depending on the strategy of the fund. But effectively, the idea is that between consistent income distributions and capital distributions that start towards the end of year 3 of a 5-year fund, by year 4, for example, between income and capital distributions, they get all the money back. So well ahead of when the fund is maturing and so on. So it gives a lot of comfort and confidence to our investors historically with this model of current yield. Finally, our goal as investment managers is to generate returns, which means that we need to generate a risk-adjusted return. So what we benchmark, each of our strategies against is typically what is a risk-free fixed income return that anybody can generate in this market. G-Secs are somewhere around 6.7, 6.9 today. And so effectively, that is absolutely risk-free, theoretically and actually speaking. Beyond that, you're able to get AAA at somewhere in the region of 7.5 to 7.7. If you were to bet, on ratings, which is a subject matter of this conversation as well, we'll talk more about it. And then, of course, you go into AAs and single A's, which range between 9 to around 10.5%. And then you go down to BBB plus, which goes into 12, 12.5. So for our real estate strategies, for example, consistently lend at 18% plus, where, post a treasury sort of situation, investors are consistently making gross returns of 17. Our first corporate credit special situations fund, is again, as I mentioned, at 18 at the portfolio level. Investors are making close to 17, 16 and a half-ish, 17 as a gross return on their hands. So the peak-off fund is expected to have a higher grade of credit in terms of counterparties and issuers, who have been in business for a long time. There are criteria around revenues and EBITDA, where, we will be backing companies which are fairly solid from a leverage, any form of ratio that you can imagine, growth trajectory, consistency of income generation, profit earning, growth on profit earnings, and so on and so forth, where there's a very, very exhaustive list of criteria, which is designed and approved by each of the investment committees of the funds, which effectively make this fund a reasonable proxy against, for example, a single A or a BBB plus portfolio. So effectively, if on a single A, one is able to get around 10.5% gross. Against that, the goal of this fund is to generate close to a 15% gross. And post fees and everything else, the investor is expected to make between 12.5 and 13%. So it's a substantial premium of 200, 300, sometimes 350 basis points ahead of what can be generated out of conventional fixed income. If somebody were to just go and invest through ICICI Direct into a bond, what would they get? You need to be able to generate a premium and a diversified premium where you have 10 or 12 transactions that diversify the risk. You don't run any concentration. You consistently generate income. You're able to churn the portfolio to keep that IRR intact over the duration of the fund. So all that hard work an investor would expect a manager to follow. So that's really what our business is about. So when we drill down to performing credit, in addition to everything that I just said in terms of being secured, being able to have consistent income generation, risk adjusted returns, and so on, why we decided to call this particular fund a performing credit opportunities fund, and have performing credit as a name in the fund itself, is because the target is against an issuer base that is at least 51 up to 65% of the portfolio will comprise of companies which are triple B plus and above. The idea, Vatsal is currently running a pipeline. Vatsal is the fund manager of the fund. He's currently running a pipeline of almost all single A companies where we are negotiating anywhere close to 15% IRRs, which are significant, attractive risk-adjusted premiums to what those bonds can be issued at in the market. And this is a result of a deal structure, a particular end situation of end use that we've identified. So for example, one of aside of the investor or the investee universe being rated and triple B plus and above, up 51 to 65%. The additional reason why this fund is, in our view, true performing credit is also because the end use of our financing must go as a precondition towards increasing revenues, increasing profits, some form of value addition that will add to the loan to value ratio that we will enjoy as a lender on that balance sheet. So effectively, it's pure growth financing where the end use is very much within the company and not going out in terms of cash outs, buying land, diverting it to some other company and so on and so forth. The value should be created and it should reside in the entity or the structure, including the obligors that the fund will have against it. So it might seem very straightforward and might seem very obvious, Arjun, but this is not so easy from our experience to implement in the market, because a lot of I hear a lot of conversations around performing credit where people fund early stage land. They will fund partner takeouts and buyouts where money goes away from the business. They will fund opportunities for promoters to buy back their own shares. So there is no real value in many of those end uses in terms of earnings and cash flows, etc., that will come back to service the fund or the investor. So we've specifically focused on trying to enhance the situations and the sort of focus, for us to be able to ensure that we lend to better quality and higher grade credit, and also at the same time monitor the end use in such a way that whatever we do is value accretive to the fund itself. So that way, it's a fairly unique value proposition, we think, in the market, and this is clearly the basis on which we have gotten the fund rated as well as a AA plus. So the rating value was derived from 2 or 3 criteria. One was what I just said. 2 is the track record, as you alluded to in the beginning of this conversation, and 3 is also because of the sponsor contribution, where Sundaram Finance has consistently sponsored 15% and above of each of the funds as significant skin in the game, way ahead of pretty much every other comparable fund that we've seen in the market, where promoter or sponsor contributions tend to be typically between 5 and in some very rare cases close to 10. But we've not seen 15% plus of sponsor contribution directly coming from a AAA balance sheet, which is what our situation is. So, and that has tended to give many of our investors a lot of comfort that we are putting our money where our mouth is, and we are backing that up with not just track record, but also consistently evolving and making sure that we create new products that will protect capital, generate consistent returns, and risk-adjusted returns. So our micro definition of performing credit is largely around creating value in the entity which we lend to, and making sure that we don't stylistically move away into higher risk situations as far as our investors are concerned. So that sort of is the macro to the micro of Peacock.
Yeah, perfect. That really answers a lot of questions. I think it also partly answers the question that I'm going to ask you now. From a macro top-down point of view, one thing that has really puzzled me is if you look at India's corporate bond market size, roughly around 550 billion or so expected by the end of 2024, and some estimates talk about how it can even touch 700-800 billion by the end of 2025. Most of this seems to be in the AAA and the AA rated space. Now, this is a space that is seen to be safe, but inflation, like you mentioned, at around 5% and above, inflation adjusted returns seem too low. So it makes more sense for me to put my money into an FD, right? In the sense that I'm looking at AAA, I'm looking at AA, where risk is relatively lesser, and given that it's 5% plus, I want to be in a safer space. Now, my question here is fairly simple. So, if I look at credit, I understand most of credit lives under the AA rated space. And I think you made a mention of that as well. Now, if I go below AA rated space, doesn't that mean that risk for me is increasing? So the way I look at it is it's AAA because it's safer, and anything that is below AA is probably not that safe, and which is the reason why it's not getting a rating of more than of AA or more than AA. Would that be right to think of it that way? Your thoughts on that?
Look, I think the way you framed your question also gives a lot of answers. But the reality, in the way we look at it, I mean, anecdotally, I mean, this is no disrespect to issuers in this country or rating agencies in this country, but statistically, the greatest amount of fixed income default in this country has happened in the AAA space.
Ah.
I mean, if you look at it, I mean, you take the names in the last 5-7 years, and I can't refer to Franklin Templeton as an example because it's public, and I don't have to worry about disclosure. But if you look at names like DHFL, Amtech, and a whole bunch of companies that have gone belly up, defaulted, and so on, they've all happened in the AAA space. So I'm not to say that ratings are faulty and so on and so forth, but ratings are a guidance. Okay. And one of the things that we are very, very conscious about at Sundaram is that yes, ratings have a purpose. They give a directional trend in terms of somebody independent having seen operations and numbers and balance sheets and ratios, and have hence come to a conclusion. And I have to take that stance simply because the Peacock fund is also rated AA plus, right? And there is a certain basis of a rating that I explained in the answer to your previous question. But ratings are not the only thing that are relevant in a credit situation. You need to go into the nitty-gritties of the credit, which we do, and we need to backstop risk and protect capital for our investors. And I've explained the way we do that. But I would say generally that ratings do influence yields. And because of this perception, that is correct. Where a AAA, as I said, 7.5%, 8% is the best probably you can get. Then you go into the AA, goes between 8 to let's say 9.5, 8.5 to 9.5, and then single A you can hit maybe 10.5 at best, and then from then on. But then our job as investment managers is to take a good risk and make it a great risk. And I'm not advertising here, and because of the caveat put by pmsbazaar, that this is not a solicitation for an investment, I am quite confidently saying this, but that's our job. Our job as an investment manager is to take a good risk and make it a great risk. And how we do that is through structuring, whether it's security, cash flow, promoter constraints, enterprise level leverage, governance monitoring, promise versus performance, active monitoring in terms of physically going and kicking the tires on each of the assets and the deals that we've done. So there are many things that go into making seemingly I would say low grade returns high grade return. And the reason how we've been able to do this is because the opportunity exists. And you began the conversation by saying that there are spaces where banks which are the largest capital provider and the lowest cost capital provider might not be able to operate because of regulatory constraints imposed by the RBI. For example, in the case of real estate, there is a certain percentage of their net owned funds that they can deploy and not more. They can only do construction finance and not other wholesale needs. In the case of non-real estate corporate credit acquisition financing, corporate restructurings, last mile capex, and so on and so forth. There's a whole host of 10 or 12 end uses which are regulatorily barred from banks to compete on. So that can be a space. or you take a company that typically approaches us and says that, hey, I'm and Vatsal probably might give you some examples towards the later part of this conversation where some of our single A rated companies have a particular need, which is either a regulatory arbitrage based on what I just told you, or the situation is that they're saying, okay, look, give me the financing where it is needed from an end use perspective, which by the way creates value, and we have a hold on that value, and we are capturing that value through a mortgage and an escrow and so on. But I'm very happy because of the way you are dealing with me in terms of quick turnaround, ability to be reactive, ability to understand my problems and work with me, understand what I need in terms of duration versus cost of capital, all of those things. I'm happy to give you a corporate guarantee from my flagship parent entity, which has got, just to pick a phrase, thousands of crores of revenues and significantly healthy EBITDA and so on. So in an interesting way, we are able to cater to the promoters' end needs, but at the same time get access to high quality balance sheets from a downside protection perspective. So I think that's the whole goal or role of a private credit manager, particularly a performing credit manager, where he's able to wrap around highly acceptable risk model, and then sort of layer that with a rating, and because of the structuring, you're able to get the yields that is a premium to typically what you could have got if you go on and subscribe to the bond of that company. A single A rated bond probably might be 11.5% with fees and so on and so forth, whereas we are shooting for close to 15%, and these are the reasons why. So, I would say that while the rating definitely from a fund perspective gives a lot of confidence to an investor, saying that, okay, there is a rating agency that has evaluated the Sundaram Performing Credit Fund based on several parameters and then has given them this AA plus rating, including the sponsor contribution and so on. But at the back end and at the asset level, they are employing all of these deal structures to make sure that my capital is protected. I get consistent yield back. In addition to which, I get comfort that a majority of their portfolio is rated, investment grade and above. So I think it's a combination of factors, which is to be applied in a judicious way, as opposed to just saying, okay, if it's a AAA, it's ought to be this, and if it's a AA, it's ought to be this. But so my brain operates, with this logic that the largest defaults have been in AAA. So I just wanted to give you this perspective and our investors and our audience this perspective.
Fair enough. Fair enough. I think that's a very powerful and a very good answer in that sense. So I think whatever little doubts that I had with that opening remark of yours, I think that all of that goes away. I have a couple of more questions. I'll club them together. So you answered the rating part. So can you just touch upon one small thing? So I learned that PCOF appears to be one of the few AIF funds that appear to be rated. So from an investor's point of view, can you just elaborate a bit more as to what it means for an investor? What should it mean for an investor? And a second follow-up question to that, from an investor's perspective, who should look at PCOF? What are the returns that can be targeted by this fund? And isn't that, given that there's too much of competition now, and I hear there are a lot of private credit funds in the market, they've actually been launched, massive amount of funds have actually been raised. Doesn't that change anything from the point of view of target returns? So two things. One, PCOF appears to be one of the few AIF funds that appear to be rated. So from an investor point of view, what does that mean? Second, who should look at PCOF and what returns are targeted? Doesn't this increase competition in the market sort of then put a lot of pressure on this targeted return concept?
Yeah, sure. Great questions, both. So you're right. I think there is a new wave of requirements, particularly from some sets of customers. For example, institutional investors like insurance companies, some of the larger corporate treasuries, who have a mandate to put monies, if it's an AIF structure, to rated funds. And so I think we are one of two or one of three funds, which are rated today in the market. And our ratings have come, as I said, from the strength of the sponsor contribution or track record, and the fact that this particular fund is focused on a higher grade issuer category, where we have held ourselves, saying that 51 to 65% of the portfolio shall be above investment grade, and we will try to exceed BBB plus, which is usually not the domain of a private credit market, where they will actually go into BBB minus and below, and largely the NCDs that the funds invest in are unrated and unlisted, where we've actually in many ways put a sort of a sword to ourselves and said that we will stick by this. So that way it's a little bit of a challenging task, but at the same time the idea is to appeal to investors which are either of the nature that I mentioned, which are institutional investors who are looking for rated funds, or even let's say an investor or an individual or an ultra high net worth who can put 1 crore has historically looked at, let me just be safe and buy bonds which are AA, Shriram Transport, Sundaram Finance, and so on and so forth. And we are giving those kind of investors an opportunity to make an alpha and saying that, look, our portfolio is going to be diversified. It's going to be cash generative. You're going to get quarterly incomes. It is going to be a universe of investees which are better quality credit. And you will get a chance to do a sort of a treasury plus type of a product, as opposed to an AIF private credit minus, if you know what I mean. So I'm saying you are able to slightly push the risk parameters, but in a very, very controlled environment, where we take the responsibility with significant skin in the game from Sundaram Finance balance sheet itself, and saying that we will create a portfolio that works and mimics the same sort of return characteristics in terms of what you would have got if you had gone and made a concentrated bet on a couple of bonds. So our goal is to appeal to, at the retail level, to these kinds of investors who are at the border and waiting for a right product to make the shift into an AIF space, and with a consistent income generation and the duration that they want. And at the other end, institutional investors who are looking for rated funds to be able to deploy a significant amount of capital. So I think this is sort of the twin goal of Peacock Fund. So I think, does that answer your questions, Arjun?
Yeah. I think that's good. So thanks a lot for this. I'll ask Vatsal some questions now. He's been patiently waiting. So two questions to you, Vatsal. So firstly, I think Karthik's explanations have been really, really very comprehensive, and it makes me understand the space much, much better. Now, like I said, I come from the equity side, from the asset management side. So I understand large, mid, and small cap listed equities. I understand how they are seen from a risk point of view. Now, while management quality is perceived to sort of taper down the cap curve, price volatility, what probably you can call as non-systemic risk, it also sort of appears to sort of increase when you go down the cap curve. Now, can I apply the same framework to credit as well? So can I say that performing credit is large cap, corporate credit is mid cap, and real estate is small cap? Would that actually be a correct bucketing that probably I might be doing, or would that be completely missing the picture on my part?
Right, Arjun. Very interesting question, I would say, from an equity standpoint. Unfortunately, it doesn't work on the credit side this way, because you might have sort of bigger companies. I mean, so I would say revenue or maybe EBITDA thresholds are not the yardstick for getting a good credit rating. It's essentially the debt serviceability ability. So I mean, lots of factors come into play to sort of get a credit rating, which in turn decides the pricing at which largely you'll be able to raise your funds. So parameters like debt EBITDA, debt equity, DSCR, these are sort of the debt serviceability parameters. I would say the industry in which a company operates, the stage of evolution of the company, the product differentiation also. Those are the sort of things that really sort of play a key role in determining whether a company is able to get a particular rating or not. So, I mean, size typically in this industry, like mid cap, small cap, large cap, it doesn't play out in this way.
Fair enough. Thanks a lot. Now, I'll come to my next question. So, you're quite the perfect person for my next question. So, sort of noticed while reading your profile that you earlier worked at Arca Finserv, a corporate credit NBFC owned by the conservative Kirloskars. Now, you appear to have done a lot of loans to AA and single A rated issuers there. Now, Karthik has cleared a lot of my questions in that space, but can you add on to that and give us your perspective on how different were the risks captured by such a strategy in your earlier avatar versus what the Sundaram Alternates peak off would sort of look to do? If you can sort of give us a sense on that.
Yeah. So, I mean, I would say where the synergy is probably in terms of backing the right guys. I think not just for Sundaram and Arca, I think it holds good for, I think, all the funds out there where you need to back the right promoters. I think that is where our key challenge as underwriters also comes into the picture. While rating, like I said previously as well, AA is one aspect to consider. There are, I mean, whole lot of other aspects to sort of take into consideration while underwriting a transaction. So I would say investment grade per se is the basic yardstick which we sort of adopt. Anything below investment grade, honestly, yeah, we do sort of take time to see whether the financials of the company and the operational track record is improving or not. That definitely is a consideration that we take into account. However, I would say it's more of a rejection parameter. If you are below investment grade, then definitely the scope of a company getting in its ability to raise funds actually diminishes. So you do have players, no doubt, who are there, but I would say NBFCs and maybe some of the funds as well, like Karthik was also saying, a better part of our portfolio will be above investment grade. So they follow a similar philosophy in terms of evaluating a credit. Having said that, at in my previous organization as well, out here as well, we do give a lot of weightage to the promoters and the ability of the company to generate cash flows, not to essentially take any refinancing risk or a bullet repayment, which is largely dependent on an event happening. We do focus on cash flows and the ability of the company to pay us out from those cash flows.
Wonderful, wonderful. That really answers my question. Thanks a lot. Thanks a lot, gentlemen, for having answered all of my questions. Thanks a lot, Karthik, and thanks a lot, Vatsal. I'll hand it over to Akshara now. Akshara, please take over and you can open the floor up for Q&A. Thanks a lot. This has been a lovely 45 minutes. Thank you.
It is indeed a lovely 45 minutes. And also, I got to see a few questions, Karthik has already been answering. So let me not take those questions. Rather, before that, while you were discussing, I had one question in my mind. If I could ask you, Karthik, so like, given that you engage in repeat businesses, so how do you prevent, overexposure to a single borrower, especially in a stressed credit cycle?
Yeah. So every fund, as part of our credit policy, Akshara, aside of addressing deal level considerations, sector level considerations, counterparty considerations, commodity or sector cyclical considerations, financial covenants, and so on, also have a section on single borrower where we consistently applied 10 to 12% at max of the fund to every single deal. So our goal is to, at any point in time, have 10 to, let's say, 14 transactions in the mix, which we think from a wholesale credit perspective is probably a pretty optimal mix between granularity, ability to manage or monitor these transactions, and also create attractive returns. Because if you go too small, then you're meaningless on the cap structure and the returns compromise. If you're too large, then it creates concentration issues. So we found that 10 to 12% single borrower is a pretty optimal sort of mix, and 10 to 14 transactions in every single fund is a pretty good mix. Also in terms of the downside thinking, where if you for example, mathematically we've modeled that if you lose 100% of capital in 1 out of 10 deals, you would end up making your capital back. And obviously, in a fixed income credit business, you can't lose capital, especially in the way we are underwriting it, with assets and cash and everything. But God forbid, even if you were to and something blows up, the investor capital is protected with one deal completely gone. So I think that's sort of the way we sort of thought about single borrower, and we've consistently applied that fund to fund.
Okay. A follow-up question is that, your fund, uses this amortization structure to reduce the risk. So during a drawdown or market downturn, the refinancing portion, option generally shrinks. So, when the borrower is not in the position to pay in a quarterly basis, and the payment schedule has been disrupted then, and liquidity biases comes in. So how does that mean? I mean, how do you face that?
Yeah, so I think this is addressed in our credit policy, Akshara, right at the outset, right? I mean, as I said consistently during my responses to Arjun, capital protection is our number one priority. So we would never lend to a business which will suddenly, capitulate or fall short of cash. I mean, usually the businesses have already had a very, very long runway. They've been in existence for a very long time. Cash flows are highly visible. So, for example, in real estate, I noticed a question from Vinal asking, real estate is very unregulated. How do you manage risks? In real estate, for example, we have a very proprietary credit policy. In the way we underwrite is quite unique in the market, and I don't believe anybody else does it. So we take zero greenfield risk. So 100% of the deals that we do are post approval. RERA approved, 30 to 50% sold, 20 to 30% constructed. So it's 100% brownfield entries into projects. Number one. Two, to mitigate the sales risk, we don't isolate ourselves in any single project, even though real estate is a project financing risk like infrastructure. Every single deal that we've done so far, has had a minimum of 2 or more projects which are running, which are brownfield, generating cash at various stages of execution with sold receivables that are mortgaged and cash flows are escrowed to us. So effectively, if sales goes down in one project, the other project comes in and pays us. And you don't end up in situations where approvals are delayed. There is some, interference politically or otherwise. There is a starting problem for a project. So all of those greenfield risks we have sidestepped entirely. Very challenging to still execute and generate these kind of returns, but we managed to do so because that's really what Sundaram Finance, as I mentioned right in the first part of our conversation, asks us to do. So they're saying, look, we are a AAA balance sheet. We've given you 15% of your fund. So you make sure that you are creating a set of boundaries and a set of rules that will work in the situations that you just mentioned. So despite all of that, if there are delays and so on, we are quite confident, and we've seen in the past that, in the 3 or 4 situations out of 60 transactions where there have been delays, there is enough equity below us, there is enough refinanceability, there is enough attraction for, anybody to come in and say that, look, even if I take these guys out, and give them a return, I still have substantial amount of equity that is subordinated to me. So our loan to values are like 2x. So, we are 30 to 50% loan to value. So most of the industry comparably in real estate, not to take names or anything, are between 70 and 75% or sometimes 80%. So there is enough room, even after taking us out by anybody, to make a healthy and handsome return, as long as the underlying of that project or that business stays intact, which is really what our credit policy addresses. So when we enter, we make sure that we don't enter sudden death, quick mortality type situations, or venture type situations, or early stage type situations, market driven risks, etc. So our goal is to get repaid out of the cash flows of the business.
Yeah.
If there is a refinancing event, if there is a liquidity event like an IPO or an asset sale and so on, those are upsides to the base case scenario, which will come in and pay us back faster. Then we get into the healthy fight in terms of how much prepayment premium will you pay me? This is what I owe to my investor. All good conversations, as opposed to difficult conversations where we stare at each other and not know what to do, right? So entire portfolios built on the back of business being able to pay us back, consistent high visibility of cash flow, strong hard assets backing each of our deals, with all the credit enhancements and asset monitoring that we are able to impose on the borrowers. So we are not going to shy away from getting paid back fast. We'd rather run a refinancing or a reinvestment risk rather than a credit risk. That is the philosophy of Sundaram. So the goal is to consistently do deals where the promoter wants to get you off his balance sheet. So if you've done that, we've done a good deal. So if the guy loves you and wants to hold on to you for 10 years, probably you've done a bad deal and you've given him a super sweet deal, which he's very happy and not eager to leave at all. So, our goal is to get off the balance sheet. We are pure lenders. We're not equity guys. We are partners in the business. We're partners in growth. We'll be very friendly, but we want to get off the balance sheet fast. So I think that's how we ideologically address the point you raised.
Yeah, keeping that as of course, in one side, there can be situations where, probably the things didn't turn up the way you wanted it to turn out. So probably you want to exit before. Rather than have IPO is a good situation. But before that, if you need to, what are is there any deal that you have done it? Like you have exited before?
Yeah, we have. So look, as I said, 99% actually of our cases is where the businesses have performed as we had anticipated or slightly better than what we had anticipated. And we've gotten paid out of the cash flows of the business. And for the same reason, a borrower is able to access capital at a lower cost than what we have lent to him at. So, I can't constrain his or her balance sheet and say, no, you must hold on to my 18% financing, 16% financing, because then I'll be throttling the balance sheet and I'm not a friendly lender. So from a repeat perspective of business, from an overall franchise perspective, from Sundaram's reputational perspective, our goal is to be very, very partnerly. And if the guy is able to generate a lower cost of capital like a PSU bank or an NBFC or any of these guys who are desperate to lend to a business at lower than the cost of capital that they can afford, and I'm saying that quite deliberately because that is a big trend that is happening in the market, we are happy to let go and say that no problem, I'll make my prepayment premium and against a contracted 16, 17, I'm going to make a 20% return. And, I'll look for the next bigger deal or next deal to invest. But in a scenario where, there have been delays, where the underlying business, hasn't worked, which is the 1% of the case that, you talked about, we've had access to pretty interesting assets, whether they are businesses, whether they are land, usually real estate in some form or fashion, that we've been able to immediately put on the block because we run a fairly solid real estate franchise. Most of the developers where we invest in the credit funds, and we're able to get a bid on the land or on the asset, or on the business, where we've been able to liquidate, sell without going to court in a very friendly fashion again, where the promoter has also made money, but he has gotten us off the balance sheet in priority. So this has happened, let's see, out of 65 deals in 3 transactions.
Okay.
And in 62 out of 65 cases, we've gotten paid out of cash flows or got refinanced at a lower rate. So that's sort of a track record from a recovery perspective. But in those situations, we plan that, if we have to exit, then, we have assets that will have a bid in the market. So I think that's how we look at evaluating the security when we underwrite it.
Okay, thank you. Let me make one question.
Of course, I did answer in one of the questions that we do have an ability to go into IBC and all that. But the goal is never to go into IBC. The goal is to have that right, to have all the bells and whistles, to be able to legitimately put that threat. But I think not a wise proposition to, quickly and in a rush take a company into IBC because that's a separate universe. Before Sundaram, I ran a distressed business, so I'm quite aware, of a completely different set of recovery mechanisms and mindset that you need to have to pull an asset out of IBC or courts and so on. So Sundaram's goal is to back good guys where you don't, hopefully face these kind of issues. And God forbid, if you do, then you have assets which the promoter is quite happy to sell and pay us back, which is really what has happened over the last 7 years.
Right, sir. And let me take one question from the audience from Pasupati. With global investors showing growing interest in Indian private credit, how does your fund position itself to compete with the international private credit players entering the market?
Yeah, so international funds, the good news from a guy like us is that international funds have a certain minimum cost of capital. They also have a certain minimum size of deal. Okay. Some of the international funds that you refer to would be the likes of Apollo, Oaktree, JC Flowers, Bain, BlackRock, Blackstone, and so on and so forth, TPG. And some of these guys have set up credit platforms in India and so on. But the minimum deal size that these funds are looking to do, would be 150 to 300 odd crores at a lower end. So their typical deal size, for example, in PAG, which is one of the very aggressive real estate lenders in the market, their average deal size and median deal size is 500 to 600 crores per deal. So for them, their target investee is completely different from us. So they would be looking in the real estate context to lend to a DLF, or a Vicky Oberoi in Mumbai, or a Shobha in Bangalore, and so on and so forth. And in the case of let's say a BlackRock or any of these guys, these guys would be looking to do deals with any of the conglomerates. So they would look to do deal with let's say a subsidiary of a Tata Group or a JSW and so on and so forth, where the deal sizes are large. A Shapoorji deal which happened, which is a $1 billion transaction. The recent Hinduja acquisition of Reliance Capital, again a $1 billion transaction. So where SSG Ares came in and put $500 million into that deal. So the competing size for offshore and international funds is completely in a different zip code versus us. And we are dealing with the 100 crore and sub 100 crore thing. So for example, we are competitive even vis-a-vis some of the mid-market funds, which are typically doing 150, 200 crores, as I understand. Like Bearings, for example, they do 200 to 250 crores, whereas we, are 100 crores and sub 100 crores. So which is, a very nice positioning for us to have. And it's also comfortable from, exposure to a balance sheet, being at a certain minimum size vis-a-vis counterparty, yet having a seat on the table. In the micro markets of the South, I just answered a question from someone that in Chennai, Bangalore, Hyderabad, or generally the South states, deal sizes typically tend to be between 50 and 100 crores versus hundreds of crores. Usually, I'm saying by a large, from a large percentage point of view. So we typically operate in that region where we also believe that there is greater value. So in Western markets, again, this might sound a little controversial, but size means that you get better deals. Whereas I've seen in India that size means you get worse deals. And risk-adjusted return is worse, and concentration risk is worse. And after a point in time, God forbid, if problems happen, the problem is not the promoters; it's yours. So effectively, the larger you go in India, I think the more problems you have. This might sound a little generalistic statement, but I've largely seen this happen in many cases. So we are quite happy to be, slightly smaller, below the radar, but consistently make our return and compound returns for our investors.
Correct. Let me take one more question from Geeta. I guess you slightly answered it, but if you want to add on some points on it. See, mid-sized corporates often lack to corporate bond market, lack access to corporate bond market international lenders. Does this create a long-term liquidity risk into your portfolio companies?
Actually, Geeta, this is really the opportunity set that we are entirely targeting. This is the reason why our funds exist. So this question is a deal trigger. And this is why the opportunity is there for all private credit funds, because mid-sized corporates are growing, they're generating cash, but they're not able to access either, public markets on the one end for one reason or the other, nor are they able to access, bond markets. And banks are taking time, because banks have over the last 10 years gone into saying that I'm going to do much, much larger credits, much more reputed companies, much larger exposures. And so, there is a distinct space in terms of liquidity requirement that has been created, for the private credit industry to exist in the first place. So this is really the opportunity driver for us. But your question is valid to the extent of exits, where I've explained, where, effectively our goal is to exit through the cash flows of the company. Versus, trying to get refinanced out or trying to get a mid-sized company to do an IPO or sell a piece of a business and so on. We are really betting on the growth of the company and consequently the cash flows of the company. So that's really our opportunity set.
So with that, we have come to the end of the session. Most of the questions were answered, probably one or two which were not taken. Probably I can send these questions to you, sir. So just kindly take some time to answer those questions and send them back to the respective attendees. And thank you for this whole time, for 1 hour webinar. And it was very informative. Thank you, sir.
Thank you, Akshara. Thank you very much. Thank you, Arjun, for the great questions, and all respect to my esteemed colleagues, and great questions from the audience. Thank you so much.
Thank you all.